All right, so we've talked so far about cash and profit. We're now going to talk about assets. So if you turn to page 16 in your participant guide, and again on the left-hand side, there's a place to look at some of the definitions. Right-hand side, a place to take notes. Matter of fact, would you take a minute and read the definitions that are on the left-hand side of page 16? Thanks for that, Ed, Keith. I've already incorporated. Okay, so what is an asset?
Anything you own or control which has value.
Anything that you own or control that has value. And you'll see that at the top of page 16. So give me some ideas of assets we have here at WasteConnections.
Buildings.
Buildings, what else?
Computers.
Computers,
Trucks.
landfills,
Trucks.
containers,
Transfer stations.
people. Now, interesting. I agree with the sentiment that people are our most important asset, but look at the definition again, Ryan, and read that for me.
Anything you own or control which has value.
Yeah, so would you still put people in that?
Depends on the person.
Here I would.
So sometimes it feels that way. Yeah, sometimes it feels that way, right? But when you look at the technical definition from a financial perspective, we don't own people. But I agree with the sentiment. Now, is the goal to amass as many assets as we can get? No, what is the goal with assets?
Leveraging them to drive economic value.
Yeah, so what we're trying to do is balance this idea of asset strength with asset utilization. Would somebody read for me what it says about asset or financial strength?
First, a company's ability to meet its future obligations and commitments.
Yeah, so this would be an organization, if the economy gets tough, this company's going to be around. Who do you think would be in the mix on that? Who would be a financially viable, financially strong company?
Apple. Because of its cash.
Apple, yeah. As we talked earlier, almost $250 billion in cash. Who else?
A lot of tech companies, Google.
Yeah, Google, a lot of
Microsoft.
extra cash. Microsoft, little debt, a lot of cash on hand. Now, again, the goal is to balance that strength with the return we're getting. Would somebody read what it says about asset utilization?
Measure how productively your assets are working to make money, to drive sales and profits.
Yeah, so in essence, we're looking for this balancing act. And we've already talked about a couple of these assets and how they need to be balanced. For example, remember our discussion on cash. We want enough cash to be financially strong and viable. But if we have too much cash, remember it doesn't generate much return. Shareholders don't like it. So cash, we're trying to balance that out. Have enough to be financially strong, but also get a good return or utilize that cash in an effective way. Inventory. We need enough to meet our sales opportunities, but if we have too much, that creates a lot of challenges as well. What about this idea for us? What would be the advantage and disadvantage of having more trucks, garbage trucks than we need? What are some advantages first? We have more trucks than we need.
Go after other markets.
Yeah, we could go after new business. If we win it, we've got the capacity to meet that right away. What else?
If some of our trucks go down, we can respond quickly.
Immediately, so we're not going to have any disruption of service on that. What's the disadvantage of having more trucks than we need?
To maintain all.
Yeah, we got to maintain them. There's an expense, even if they're just sitting there. What else?
Cash tied up and
Ties up
they're not
cash.
being used.
Yeah, and probably not getting a good return on that. So you can see with trucks as an example, we're trying to get the right balance on that. Let me give you a couple of examples of companies who've also wrestled with this balance. ExxonMobil in 2016 has a AAA credit rating that they've had for over 67 years. What's the advantage? By the way, when you get, you borrow money for a home, you get a personal credit rating. Companies also can get a credit rating as well. There are 4 companies who do that: S&P, A&M Best, Moody's, and Fitch. And the highest rating, and they've got a little bit of a different rating system, but the highest rating, AAA rating. What's the advantage of having a AAA rating for a company?
Access to more capital.
Ability to borrow more money and
At a lower rate.
at a cheaper rate. So there's a real advantage. If you go back about 40 or 50 years, there were quite a few companies with AAA credit ratings. And ExxonMobil had its AAA credit rating in 2016, still at AAA. It did a few things around this time frame that caused it to lose its AAA rating. Any guess on some of the things it might have done?
Need acquisitions possibly?
Acquisitions. They're also paying higher dividends. They're also taking on some projects. As a result of doing all of that, they were trying to get a better return on its assets and its cash. But a result of going after that better return caused them to lose their AAA rating. The reason: high capital spending on major projects, increases in dividends, and lower oil prices. But again, they're seeking that balance. AAA credit rating's great, but if you're not getting a good return, then they sought to find more of a balance. By the way, there are only 2 non-bank AAA rated companies in the United States. Any guess on who they are?
Microsoft.
Microsoft and Johnson
J&J.
Johnson. Yeah. One of a famous entity right around 2011 lost its AAA rating. Any
Berkshire Hathaway.
GE.
Berkshire, GE? Still thinking of another entity.
ADP.
I'm being
United States
United States
US
government. Yeah. And do you remember at the time? By the way, remember there were 4 agencies. It was S&P that lowered the rating. Do you remember why? The reasons they stated for lowering the rating? Said 2 things. One was the increasing debt. I think at that time,
Congress's inability to
make
and that was
decisions.
the second, Congress's inability, or they're worried about their ability to come together to make decisions. Anyway, yeah, here's another example of a company that lost its AAA rating. Berkshire Hathaway, owned by
Warren
Warren Buffett, 2009. He lost his AAA rating. Do you recall what he did around this time to lose?
Didn't he buy Burlington Northern?
Yeah, Burlington Northern Santa Fe Railroad. And part of the reason he gave for this is a railroad can transfer 1 ton, 500 miles with 1 gallon of diesel, which is 3 times more effective than trucks. So, Buffett's always betting on the economy and the U.S. economy. He's a big advocate. And so, again, this was an example of Warren, AAA rated, a lot of cash. He decides to invest that, take on debt to buy a big company in order to get a better return on his cash. I got to think that Warren knew he was going to lose his AAA credit rating in the process. He was smart enough to see probably that happening, but was willing to make that trade-off.
I think he actually stated that, by the way.
Yeah, I think he did.
He came out and said it was on purpose.
Yeah. So if we look at our numbers, our strong, so this was from our earnings call. Our strong financial profile continues to afford the flexibility to fund outsized acquisition activity and increasing cash dividend and opportunistic share repurchases. Remember, in cash, we talked about our 3 primary objectives with cash. One was we would go after acquisitions. If we have leftover cash, we'd be looking at dividends and share repurchases. But this is referring to our strong financial profile. So our credit rating was reasserted or recertified here not long ago. And with S&P, we've got a triple B plus. With Moody's, we've got a triple B2. This puts us in a lower median range. And by the way, about 70% of the S&P 500 companies are in this lower median range. Now, would we love to have an improved credit rating?
Yes.
Yeah, which means what, Kenny?
Access to more capital
At a cheaper rate. Yeah, what would we have to give up potentially to get a better credit rating?
Utilization.
So what would be so we might not go after as many acquisitions. We might not pay as big a dividends as we are. We might not buy back stock. So to a degree, we're making the same trade-off. We're comfortable in being in this range, given the investment opportunities we see and our desire to get a better return on our cash and the assets that we have. By the way, it's interesting when you look at what the different ratings give you and the borrowing rates. A triple B is about 122 basis points over the treasury rate, whereas a triple A is 56. We're talking about 70 basis points difference between a triple A and a triple B. So there's not, if you look at it this way, there's not huge incentive to make all those trade-offs to get a better return because the incremental improvement in borrowing rates isn't that significant. And rates are already so cheap anyway.
Do you define investment grade versus non-investment grade?
Sometimes. Yeah, and by the way, below a triple B then would be non-investment grade. Sometimes they call that junk bond status. And you can see the rates here become fairly significant. Here, you're sort of in question of being a viable company. And so everybody's looking at being at least triple B plus. And you can see the rates really are adjusted to suggest that The risk is a lot lower, and you're kind of a viable growing company, going concern. if you will. All right. So also from our earnings call, debt outstanding at quarter end was about $4.2 billion, approximately 23% of which was floating rate. And our leverage ratios defined in our credit agreement ended the year at 2.4 times debt to EBITDA. We're currently very comfortable being higher than that, and in the 2.75 range we think is a good place to be because we can take leverage up to 3.5 times or even higher for an outsized deal if that opportunity were to present itself. In other words, we feel very comfortable with our current debt and feel even, would be very comfortable with taking our debt even higher if we saw the right deal, the right opportunity to buy another company on that. So the point is, our balance sheet is strong, and even is in such a place where if we want to borrow more money, we're able to do that. So let's look at a measure that really highlights our asset strength. Brent, can I pick on you?
Sure.
So let's say Brent decides he wants to start investing in real estate. And he's going to start picking up some properties locally and buy them and see if he can make a good investment on that. Let's see he buys his first home here locally, and a home would be an asset. What would be the average home price around here?
400,000, 300,000, 200,000. I don't know.
200,000 sounds like
Thank you.
a good number.
I said 4. You look like
Yeah.
I can do it.
Now, if Brent were to buy this home, which is an asset worth $200,000, if he's like most homeowners or most home purchasers, how much money would he likely borrow?
160.
Investor.
$160,000. And that $160,000 is going to be a liability, which means how much equity will he have in the home?
40,000.
40,000.
Yeah, he's going to have $40,000 in equity. Now, what's the relationship of equity to assets in this scenario?
20%.
20%. That's actually the average equity ratio of the S&P 500. About a 20% equity ratio. Now back to Brent's scenario. What if he had, instead of just 20% equity, he had 50% equity in his home? So he had $100,000 in liability and he had $100,000 in equity. What benefits would that give Brent as an owner of that property?
If he gets fired, he can live off the equity.
Yeah, he could. He's got plenty of room to borrow more money if he needed to. What other advantages does that give him if he has more equity in his home?
Go buy more homes. Go buy more property.
So you borrow more, that money and use it to go buy another home. Any other advantages he'd have?
Credit ratings.
Better interest rates.
Probably better credit
rates,
rating,
income
better
tax
interest rate. Yeah, also his interest payments are lower, so his debt service isn't as high. Those same benefits exist for companies the higher the equity ratio they have. So again, I mentioned a minute ago, the average equity ratio of the S&P 500 is 20%. And you can see our trend over the last 5 years. We're at 51%. What does that suggest about our equity, about our balance sheet strength?
We have less debt than other companies do, and more flexibility.
What is our debt to assets?
The opposite of that.
Which is
49%.
49%. Average company would have how much in debt to assets? 80%. We have a lot less debt than the average company, a lot more equity, which, like for Brent in a home, means that if we need to borrow money, we've got the ability to do that. Also, we have less debt service than the average company, so we have fewer or less ongoing interest payments as well. I usually spend a few more minutes on that. I won't spend the time. Here's the equity ratio, our equity ratio compared to the other companies.
Because we just bought the number 4 company.
Hasn't closed yet. So,
It's because your assets are all goodwill.
There we go. Oh, snap!
Your goodwill
Here comes the garbage.
2x that of Republic as a percentage.
we could go on. So now that we've talked about asset strength, let's talk about asset utilization. There are a lot of ways you can measure the return or the utilization you're getting on your assets. You can look at return on assets, you can look at return on equity, we like to look at return on invested capital. And if you look at this equation, you've got after-tax operating profit divided by invested capital. In other words, what's your profit or return you're getting on the net debt and equity that the company has. If you look at our 2018 equation, here's the after-tax operating profit, basically on the debt and equity that we have. And you think about debt and equity, it's what investment dollars have been put into the company. We borrow money, we should be getting a return on that. Shareholders leave equity or put equity in a company. They're looking for a return on that. So that's why investors like this return on invested capital. Do we want this number higher or lower?
Higher.
Higher the better. What are our two levers if we want to improve return on invested capital?
Higher profit or less invested capital?
Yeah, we can either improve the profit we're getting on existing capital or reduce the capital needed to get the profit that we generate as an organization. So all of these measures, and by the way, here's our ROIC compared to the others.
Hey, Cap, participant question.
Yeah.
Why don't we use net income? Why do we use, or EBITDA? Why do we use the profit metric that we use in the formula for ROIC?
Do you want to hold that for the end?
Sure.
Or do you want to use the, that's not a process. That's
Why
a real question.
do we use after
It's a
tax?
participant question. Why
Yeah.
do we use after?
You know, Ryan and I were talking about that at the break. Ryan, do you want to hit that one?
Think of me.
Yeah.
Why do we use what?
Pre-tax. You and I were having this conversation. Why do we use a pre-tax number instead of a post-tax number when we're looking at this?
Oh, because we're going to compare it to a cost of capital, and no, we weren't talking about this.
We were a couple months ago.
Oh, a couple months ago. Oh. I'm like, am I supposed
I was
to say
being
this?
real time.
Oh, sorry. Yeah, so the question is, why do we use the after-tax operating profit? Is that the question? Yeah, because you're going to compare this to your cost of capital, and interest expenses are factored into the cost of capital, so you don't want to double count against you.
Gotcha.
If that makes sense.
No, but
So it's pre-capital structure is the short way of saying it.
Normalized.
Yeah, we're eventually going to look at this and return on this capital relative to our cost of capital. Interest is part of that cost of capital. So if you're accounting for it in your return on invested capital and then also counting it in your cost of capital, you're double counting. And that'll become more favorably calculated as you put it as cost of capital.
All right, I'm going to skip through
Hey,
these.
how did the public service do compared to waste management?
Did real well.
Go back on
So-
that. Let's look at that real quick.
So ROA and ROIC looks at the return on assets or investments that are already in place. So how do you make the next decision on whether to invest capital or not, right? So we've been looking at numbers that reflect our current return on existing assets. So what if you're faced with a decision right now whether to buy a truck, to make an acquisition? And so how do you make that decision? Well, let me set it up with a voting question. So grab your voting pad if you will. And answer this question. You just won the lottery. And as you know, lotteries give you options. So which of the following options would you take? See, we're at 5 votes here.
What's the rate? We're just guessing, right? Not supposed to.
I don't know.
well, you know,
Ideally, working the math on what rate of return you
Yeah,
think
exactly.
you get.
What's the return you think?
there's
you
no
might
math
get?
to work without knowing the interest rate.
7, 8. We'll take 8 votes. That's a majority.
Opportunity cost.
Most of you decided to take $1 million today. So let me pose this question. What were the considerations you were thinking about as you were voting on this this option? What
rate of
was in your
return-
mind?
What rate of return I could get in that investment?
Yeah, so so one option was what kind of return are they going to give me if I take a later option versus what kind of return could I get if I invest on my own? Okay, what else were you thinking?
Got specific. I got a house I want to buy. I got to buy my dream home.
Okay, so another would be, is my immediacy for cash now or can I wait a period of time? Anything else that would weigh into that?
Can they pay it in 3 years?
So, is there any risk in waiting? Might the lottery fund go defunct or
What if I die?
bankrupt or something
I
like
felt
that?
like the first year 1 to 2 was the greater return, 10 extra %.
Yeah.
And then each year after that it was
So it's a
lesser
little
and lesser.
diminished.
Yeah.
So that's why this
So I
felt a
went
little
to 2
better.
to get the best 1-year return.
Yeah, no, I like that. If you think about it, there were quantitative and qualitative thinking that you were doing sort of mentally in your mind. For example, what we talked about, what kind of return could I get on the money if I take it now? You're also looking at, do I need the money now, or is there risk in waiting? So you kind of hit all of those in your own thinking. Well, I want to go through a process that would help us make an intelligent decision around this. And in this, I want to go over 4 ideas or financial ratios, terms, theories to do that. We're going to look at the time value of money, hurdle rate, net present value, and internal rate of return. Now, you could spend a whole semester on this. You could spend a couple of years on this. We're going to do this in a fairly condensed version. So what I want to do is not make you masters of this, but have you really get an overall sense of what they're telling me, what they're meaning. So as we talk about these inside the company, you have a sense of what's being discussed and can contribute as part of those discussions and also those decisions. So let's start off with this. This is a cash flow diagram. And in this diagram, you're seeing 4 years period of time, today basically, 2019, a year from now, 2020, 2 years from now, 2021, 3 years from now, 2022. A down arrow in this cash flow diagram would suggest you're having to put money in, either a down payment or ongoing maintenance, but this requires us to put money in. In this case, I'm proposing $100. Any up arrows with a green number would suggest we're getting a benefit or a return. So in this case, it's suggesting I put $100 in, and 3 years from now, I'm going to get $100 back. Are you with me so far? Is this a good investment?
No.
Is it a trick question?
No. Why is it? Why is it not a good investment?
You're not getting any rate of return. You've been illiquid. It goes for 3 years. You didn't have the access to it. You couldn't do anything with it. You got no value given the time or the risk
You
associated.
took risk, and you could put that under your mattress and it would be the same.
Unless you were in Russia during the collapse of the ruble, then it would
that's
have been
right.
an awesome
Unless
investment.
you're in a real
I've had
So in
worse
today's
investments.
environment,
Yeah.
I could see where, there were negative interest rates for a period of time not long ago, but in today's environment, this isn't a good return.
You have to
Why?
include, I think, I don't know whether you do it, but as a participant, I would say, what about inflation? You're losing money.
No question.
Yeah.
Yeah, so this is actually $100 3
Less.
years from now is worth than $1 today. That's the whole idea of the time value of money. Receiving $1 in the future is less valuable than getting $1 today. Now, let's assume that if you put money in an account right now, you might get something like 2%.
So
That
you're
might, at today's inflation rates, just keep up with inflation. So if you invested $100 today, how do you figure out what this is worth 3 years from now?
Times it by 0.02.
Yeah, so if you look at compounded interest, this $100 today at 2%, a year from now is worth $102. Now, if you're getting 2% not only on the principal and also the interest you earn, that's compounding it, which means that it's worth $104.04 in 2 years, or $106.12 in 3 years. That's the idea of looking at compounding interest. This $100 invested today being worth $106.12. Would this be a good investment for us today? Why not?
Because our cost of capital is much higher than that. Our borrowing rate is probably 8% on a weighted average basis. And so we got to at least cover that, and 2% is not going to cover that.
It won't. Matter of fact, our hurdle rate, when we are looking at making an investment, as you all know, we've put that at 12%. That is our hurdle rate. In other words, when we're looking at any kind of investment decision, we want it to at least hit that 12% to even decide if we want to do it or not. Now, of course, we could do one for less than 12%, but we'd really have to think carefully about it. But we're looking for that hurdle or minimum rate of 12%. Hurdle rate, the minimum amount of return that a company requires before they will make an investment in something. Again, ours is 12% on that. So how did we come up with 12%? Well, there's a complicated equation called the capital asset pricing model, or the CAPM. And here's that equation. And basically, it's looking at the average of your cost of debt and your cost of equity, and averaging those two together to get what our weighted average cost of capital is. So there's two parts of us acquiring or getting cash. We get it through debt. We also get it by retaining profits, or shareholders putting money in the company. That's the equity side. Which one of these do you think would require or expect a greater return? Banks loaning us money, or shareholders who have equity in the company? Who do you think is requiring the higher return?
Shareholders.
Why?
Because they're
More
taking
risk.
risks.
More risk.
What do you mean? Why are they taking more risk?
The company goes down, debt holders get all their money first, so equity holders
do a lot to mitigate their risk.
Okay, so yeah, they are maybe last to get paid. If a company goes bankrupt, money is owed here. Also, when do shareholders get benefited? If they do get a return, when do they get it?
Either in dividend or.
After everything else has been paid, and this is excess profits. Now, what about a bank? When do banks get paid?
Every month.
Yeah, they've got a regular schedule. Why is there less risk for a bank?
Risk mitigation.
They don't have the asset.
Sometimes it's collateralized. Also, it's required every month. What if we're not profitable? Do we still have to make the payment?
Yes.
Yeah, and so there's a lot less risk for the debt holders than there is for the shareholders. We have estimated, we like to think of our cost of debt at about 6 to 7%. This is a long-term measure for us, because right now we're at about 3.4% as our average cost of debt. But if we think about it long-term, we don't want to make decisions today that impact our results for 20 years with artificially low rates that exist right now. So we like to put our cost of debt at about 6 to 7%. Our cost of equity at about 14%. And so the combination of these two put our weighted average cost of capital at about 12%. That's why we've determined our hurdle rate. We at least need to generate enough return from our investments, that's the minimum hurdle, in order to cover our cost of capital. What if the returns we're getting are below the cost of capital?
It's a crummy investment. It's not a good investment.
Yeah, we're actually destroying value. We're borrowing money that's costing us about 12%. We're only making 11%. We're actually destroying value. So that's why we've got this minimum hurdle rate at around 12%, which represents our weighted average cost.
So you said our return on invested capital is 7.7, but our WACC is 12. Does that mean we're destroying value?
Say that again.
So you showed a little earlier our return on invested capital is 7.7%, and yet you're saying our weighted average cost of capital is 12. Does that mean we are destroying value?
What do you think? It's a great question.
Not necessarily. It's not typically good in the short run. It all depends on what kind of additional return you're giving back to shareholders in dividends or other ways to mitigate some of the implications of something.
Yeah.
And our dividend philosophy seems to cover some of that.
Yeah.
Or just some of that.
Yeah, when you also look at the return on invested capital, it also takes into account broader set of assets that might not necessarily get the return we're getting now on it. And some of those assets could be valued at a much higher rate than what we paid for them originally. So that could have an impact on it as well. Is there another hand up?
Well, didn't you say that right now our cost of debt is pretty low? So
It's more like
so
3.4%.
you could kind of theoretically say that when we're doing long-term planning, we make this assumption at 12%, that right now we can actually create value at lower returns.
We could, yeah. Yeah, so we might, because of that, we might do a deal at 10% if there are other mitigating factors that suggest that might be a good deal, and still, probably get a good return on that.
And are these actually our numbers, the cost of equity, cost of debt?
Those are the numbers we're using now, yeah. They're WasteConnections. I think this is still publicly traded information. All right, so let's assume we invest this $100 today using a 12% rate. How would we calculate what this thing should be worth in 3 years? Do the same kind of scenario where we take the interest rate. So in a year it's worth $112. If we then compound interest, so interest on top of the interest plus the principal, $125, in 3 years $140.49. This is the future value of today's investment. Are you with me on that? This is the future value of today's $100 investment. Now, said another way, if we wanted to know what the present value, if this is what we have to invest, here's the future value, how do we calculate the present value of this $148.49 using that 12% discount rate? So if you discount this 12%, then 12%, then 12%, it's actually the present value of this future cash flow stream is worth $100 today, using a 12% rate. Now, what is our present value on this investment that takes $100 now and is worth, and the present value of the future streams we would get is worth $100 today? What would be the present value of this?
Present value.
You mean the
Net
net present value?
Net present value of this.
Zero.
Yeah, it's worth zero. Would we do this deal?
Me. We wouldn't discount it, or we wouldn't kick it out of bed for eating crackers.
Did it meet our hurdle rate? It just met our hurdle rate. So then it would beg the decision, are we interested to do it? Knowing that our interest rates today are probably a little bit lower, there'd probably be a good consideration for this deal. So what is the net present value of this deal? Remember before, $140.49. What if we knew we could get $150 in the future? What would we do to get a sense of whether this is a good deal or not? We would discount this future return in today's dollars. Again, using 12%, discount it for year 1, year 2, year 3. This deal, the present value of this revenue stream in 3 years is worth $106.04. What is the net present value of this deal?
$6.04.
Yep, if this is what it cost us, here's what the future revenues are worth in today's dollars. Net present value is worth $6.04. Now, here's the interesting thing. This deal is also worth $6.04, but requires $10,000 now, gets $14,000 in the future. Same net present value for these two deals. How would you decide which one's the better deal to do?
Cheaper.
Less risky.
Less risk.
Less capital tied
Less
up.
capital.
Is there a calculation you could do to get a sense of which has the better return?
ROI.
They would call that the IRR, the internal rate of return, which is the time-weighted return of an investment expressed as a percentage. The higher the rate of return, the better the investment. So basically what you do is you figure out at what rate do I have to increase this to until this becomes zero. That's how you get internal rate of return. And instead of doing the calculation, there's actually a calculator we can find in order to do that. By the way, before I show you the calculator, it will show you that if the rate of return is 14.47%, we then get a zero net present value. So the internal rate of return of this deal is 14.47%. Let me just say that again. IRR calculates at what discount rate I have to make that $150 equal $100 here, so that's a zero net present value. In other words, what is the rate of return that gives me a zero net present value? That's the IRR. Or, as I said before, the time-weighted return on investment expressed as a percentage.
In the other situation, you'd be at probably a 12.1% IRR because you barely needed a $10,000 initial investment.
Correct.
So you get a 14.4 versus a barely over 12. It's that first scenario that you have.
So if you would, grab your phone, or you can use your computer, whichever you'd like, and go to Google and put in NPV IRR calculator. And about the third entry or so will be this datadynamica.com. And click on that website. This is actually a net present value and internal rate of return calculator. So instead of having to do the math or call somebody, you can actually grab this calculator, it's free, and we're gonna go through a few calculations to show you. So do you remember our scenario where we invest $100 now? So what you're doing, we're seeing 7 periods of time here. A negative number means you're having to put money in. A positive number means we're getting a return or cash back. So in this scenario, go ahead and put minus $100 in for number 1 period, which would be today. You done that? Okay, now if you would put $150, and it's positive because we're gonna get $150 back in 4 years. What discount rate or weighted average cost of capital are we looking at? 12%. So if you would, put 12% down here where it says discount rate. And then push calculate right here. And what you should have come up with was 14.47 for the IRR. Did you get that? And a net present value of 6.76. All right. So, most investments, as you look at doing a cash flow analysis, which we've been talking about, some of the real art in doing that is not so much how to do the calculation. We can get a calculator for that, but is making the right assumptions. In other words, how much is it going to take today? That's probably an easier assumption. What are some of the tougher assumptions you've got to make?
The amount of ins, the amount of outs, when will the ins come, when will the outs come, based on what kind of market reality, what competitive dynamics you're dealing with. You just got so many different things you've got to try to kind of encapsulate in some of this data.
That's exactly right. So we're pretty clear on what it's going to take today. Let's think of a truck. We're really clear on what it costs today. We're not exactly clear on the maintenance. We can guess, and we can get pretty close because we have thousands of trucks. It's also sometimes a little harder to get at the benefit. Maybe it's not going to be fully utilized, or it's in an area where we're not doing so well as a company, or an area that's really busy. So the ins and outs are harder to calculate. Let's assume though, so we've done all this analysis and we're pretty confident that if we put $100 in and then we have to invest $20 here in maintenance, then $35 here in maintenance and here in maintenance, and this is the benefit what we're gonna get. How would we do, using our calculator, the cash flow analysis for this?
Net each year.
So first of all, 60. There's not an opportunity to put two numbers in for year 2. So 60 minus 20, we would be putting in 40 here, 45, 55 here. So go ahead in your calculator, year 1, which is now, put minus $100. Year 2 plus 40, year 3 plus 45, year 4 plus 55. What's the discount rate?
12%.
12%, push calculate.
17.87.
Okay, now before I do that, here's what the calculator is doing. It's basically discounting this back 1 year, this back 2 years, this back 3 years at 12%, right? It's basically calculating this. You said the net present value was what? 10.73%, and the IRR is going to be 17.8%. Would we do this deal as a company?
Yes.
What's our hurdle rate?
12.
12%. What's the IRR on this? 17%. It's above our hurdle rate. So this is a deal we would strongly consider. If you would, do the calculation on this one. And then look at me when you've done it, and then I'll know that I can show you the answer on this. Okay. 33.87% IRR, is that what you got?
Yeah.
And a 42.29% NPV.
Yeah.
Okay. Would you do the deal? Yeah, again, this is above
What
our.
are we waiting on?
You what?
What are we waiting on?
Yeah, let's do it now. So let me ask you this question. This is the same scenario you just worked through. Does lowering the discount rate on this deal, on this investment, improve NPV and IRR? Oh. Let me ask the question again. Does lowering the discount rate, we put in 12%, does it have an impact on NPV or IRR? Do this, go ahead and put 11% in and see if the numbers change.
Just the NPV.
Just the NPV, not the IRR. IRR is what it is. NPV is gonna change.
So when we lower the discount rate, that does improve our net present value, does not change the IRR. So let me pose this question. What are the advantages or disadvantages of lowering the hurdle rate? Instead of 12, let's say, hey, we think our cost of capital is lower. We're actually borrowing at 3.4%, not 6 or 7%. what would be the advantage of lowering our hurdle rate?
The advantage,
Yes.
you have more things in your wheelhouse if possible.
Yeah, a lot more deals are going to pass, right? More deals are going to pass. That could be an advantage.
Could be a disadvantage.
Yeah. What would be the disadvantage?
Well, you might be choosing deals that aren't as lucrative just because they pass your hurdle
You
rate.
might have more.
Okay.
deals.
You're not looking as hard as.
Okay, so if we've got a lot of capital, we might be willing to lower our discount rate a little bit, but not so far that we're losing money. Also, if we're interested in growth, lowering the discount rate would allow us to approve more deals and to help us grow the revenues faster. Again, the disadvantage would be, well, we're not getting this higher return as we could otherwise. So there are advantages and disadvantages of doing that to improve NPV. But remember, IRR does not change even if we lower the hurdle rate. So here's what I'd like you to do. Get together with two of you and tell me which of these options you would do. Using a 12% discount rate, which of these investments would you pick? So pair up with somebody, Keith and Brad, Kenny Ryan, Ryan Jeff, Monty Ben. Do you want to, Kelvin, do you want to work with them?
Sure.
Oh, yeah. That's okay, I'll do it. Great, yeah, you and I are doing the first one, Ben's doing the second one.
You can do a short.
12% discount on both.
12%, right? Okay.
12% discount rate. I hear what you're doing.
I just said I don't want to screw up your recording, but I'm gonna ask you some questions later.
Yeah, and I've got a real robust answer. I'm not sure I can talk to you about.
Time of eternal value.
All right, who's ready? You guys ready?
Do that right.
You guys ready to make a decision? All right, you guys ready? Okay, so who would vote number one? Who'd vote number two?
Quantitatively, we vote
We're cautiously optimistic about O2.
Yeah, bottom line is we do both. So it's a trick question.
because they both have higher.
Because they both have more than a 12% internal rate of return, positive net present value. So both these deals are good. Now, if you had to choose one, obviously you might consider the one with the higher IRR
The
potential.
challenge is, yeah.
Go ahead.
See, the challenge with option B is you're not cash flow positive for, 2+ years, where you actually get it within a year, you're starting to finally
another
get some
yeah.
positives.
Another consideration. So if you are really tight on cash flow now, you might choose this option, even though this one has a better return, which sort of leads us into this idea of qualitative and quantitative. Before I get to that, let me just suggest there are 4 levers. If you want to improve NPV and IRR in your existing assets, there's 4 kind of ways that you can think about doing that. And again, we'll use a garbage truck as an example. Anything you can do to increase revenues. I'm going to speed through this because everybody knows this part, right? Yeah, I'm going to speed through this. Anything you can do to reduce an asset's original or ongoing costs, like original cost of the truck or ongoing maintenance. Anything you can do to extend the life of the asset. If we maintain it right, we can keep it on the road longer. Or anything we can do to get the asset up to speed faster. So when the truck gets here, it's already configured, ready to go, we can get it on the road. So those are 4 ways when you think of any asset. Copy machine, a building, anything that we could do to improve the return that we're getting on that asset. You've just determined investment has a good NPV and IRR. What else needs to be considered before making a decision? We've just done the quantitative math. Just gave it away. You've just done the quantitative math. What else do you have to consider in making an investment?
Emerging market.
Yeah, the qualitative side of this, including what its competitive landscape. It may be that we'll do a deal because we want to keep a competitor out. Maybe it doesn't quite hit a hurdle rate, but if we can take advantage of that market, it gives us an inroad. It could be that there are other synergies with other investments. We've got a landfill just down the street. And so doing this deal really takes advantage of the landfill that we have. Local management's ability to run a project. Maybe we've got a team that's already really tapped out and quite busy. We might not want to throw another tuck-in acquisition or opportunity to that team. Does it align with your strategic priorities? If we are shifting our focus more to growth than profit, we might be willing to do a deal even if it just barely meets the hurdle rate. So that could be a consideration. You also have jump-starting a group with more investment. Maybe you've got a group that has capacity, or it's a new group and you want to give them an opportunity to sort of spread their wings and grow the business. So the point is, even when you do the math, there's still the question of, is this the right deal, or are there compelling reasons to do this deal? Or if it doesn't meet the 12% hurdle rate, but it's compelling because of some other qualitative issues, we might do the deal as well. I'll speed through that. So let's go back to this scenario I started this whole discussion with. And just in case you do win the lottery, here's how you might want to take your money. If you can get a 5% rate, that's all you could get on the money. If you take it now, you're better off to leave it in and take $1.3 million in 3 years. If all you could get is 5% on your own. However, if you get 12% on your own, you've got an opportunity to get the money now. You'd be better to take the money today. So when you do win the lottery, give me a call and we'll figure out how to, think through whether you ought to take it now or later on that.
You only take a small
You
piece.
just take a small cut.
You should do the
Maybe.
IRR at each point.
Yeah. So in summary, $1 today is worth more than $1 a year from now due to the time value of money. Second, the hurdle rate sets the minimum percentage return required to make an investment. Number 3, the net present value is the value of the future cash flows, positive and negative, over the entire life of the investment, discounted to the present. Number 4, the time-weighted return of an investment expressed as a percentage. The higher is the IRR. The higher the rate of return, the better the investment. And then last, there are also qualitative considerations in making a decision. What I'd like you to do is to pair up with somebody. Person 1 is going to explain in their own words what time value of money is and the hurdle rate. Person 2 is going to explain NPV, IRR, and then the qualitative. So take about 3 minutes each. Go. I'm not going to do that, but that's what I do here, to do a reteach to reinforce that. So as we wrap this up, let me give you some examples of companies that have done well around this. Everybody's familiar with Southwest. You might not be familiar with Ryanair. Has anybody seen Ryanair? Okay. No seat back pockets means less time to clean planes. They save about a minute or so in the turnaround of a plane because of no seat back pockets to clean out. Another example of assets in action. You guys have all seen this one, I'm pretty sure. So what can you do to improve return you are getting on existing or new assets, considering the 4 levers we've discussed? Greater revenues or benefits, less cost, extending the life, getting assets up to speed faster. Take 5 minutes in your table groups to talk about our existing assets, what you can do in your role to have an impact on getting a better return on those assets. We debrief that. Now, if you take a minute to write down under my impact, what's your one takeaway? We've just generated a lot of ideas. I want you to narrow it down to the one specific idea you're going to take away from this. And I'll pick on a couple of you, so if you would take a minute to write that down. All right, we've just debriefed some of those. I picked on a couple of you. What are you going to do, Brooklyn? Ben, what are you going to do? What'd you write down, Ryan? All right, grab your voting pad. Answer this question. What is WasteConnections' hurdle rate? 12%. Which industry would tend to have a higher return on assets? Yeah, we got a mixed result on that. Why would a consulting company likely have a higher return on assets? Very few assets. It's a very human resource-driven kind of business, plus they tend to be fairly profitable. Last one. Who are the 2 remaining AAA-rated non-financials in the U.S.? All right, didn't get any votes for Sears and Toys R Us. The answer is Microsoft and J&J. Let me show a video clip as we wrap this one up. And I assume everybody's seen this.
I'd like to hear you explain that, honestly, because I don't get it.
Oh, don't you?
I don't.
Yeah, so in this discussion, we've been talking about, as we are considering making a purchase or an acquisition or investment, really counting what's the return we're going to get on that. Here's a young kid making a case for the return he would get on owning a dog.
Got it. All right, good enough. You don't have to show.
Greg, the other way I do it is I've done budgeting before, and I say, hey, here's the budgeting process, and they're sitting, you got two business managers that are sitting in front of the capital committee or budgeting committee, and they're both asking for an increase in budget. Which one gets?
Yeah, that's good.